my personal opinion, is the best long-term investment theme, is punching everybody in the face right now. And nobody wants to kind of realize what's happening. And I think it's all about deglobalization.
Rich Bernstein explains next on Consuelo Mack WealthTrack.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategist Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this special 20th anniversary edition of WealthTrack. I'm Consuelo Mack. When we launched WealthTrack in the summer of 2005, we had a mission to help individuals build financial security to last a lifetime by becoming better investors. To do that, we wanted to tap the brains and experience of best-in-class investors, financial thought leaders, and advisors, and we wanted to talk to them at length, not just about what they were investing in, but how they invested, their process, their objectives and expectations, their discipline and culture. Early on, we wanted to talk to people who were known not just for their long-term performance, but as important was their professionalism, reputation among peers, and their integrity. We also established a no jerks rule. We had to like them. So starting this week, we are inviting some of our early WealthTrack guests back for their 20-year perspectives, and of course, their current thinking. Our first guest for the 20th season first joined us in 2005 when he was the Chief Investment Strategist at Merrill Lynch. He has been a regular ever since. He is Richard Bernstein, an influential investment strategist who is Chief Executive and Chief Investment Officer of Richard Bernstein Advisors, which he founded in 2009. The firm now oversees or advises nearly $15 billion in assets, largely in multi-asset allocation strategies for financial advisors using ETFs, mutual funds, and separately managed accounts for institutions. RBA has been recognized as one of the fastest growing investment firms specializing in asset allocation portfolio solutions. In his previous life as Merrill Lynch's longtime chief investment strategist, he was inducted into the highly selective Institutional Investors Hall of Fame for his 18-year tenure on his prestigious All-America Research team. Rich is known for his macro analysis and thematic investing. So in the first of a two-part interview with him, I asked him to identify the most successful themes of the last 20 years.
One of the investment themes of the last 20 years or so that's really gone under the radar has been the simple compounding of dividends. I think people forget that this is one of the easiest ways to build wealth through time. People have forgotten it. So if you look at dividend-paying stocks and you reinvested the dividends over the last 20 years, you did very, very well. You don't light up a cocktail party telling somebody you're buying dividend stocks and reinvesting the dividends, of course. But I think the goal here is building wealth, not being popular. So I would say number one, right at the top of my list, is compounding dividends. Has been a fantastic theme. And I would argue it should always be a part of a wealth building portfolio.
You're a long-term investor, you advocate long-term investing, but are there shorter themes that can be successful as well, and have there been?
Oh, absolutely. And I think, one has to remember that the profit cycle is really going to determine those shorter-term themes and the success of those shorter-term themes. So when profitability is starting to rev up in an economy, you want your portfolio to be exposed to those more cyclical investments, but when profitability is slowing down, you want it to be more defensive. And so, rotating back and forth between growth and value, large and small, high quality and low quality, all those kind of things has been a very good way to invest as well, obviously with a shorter time horizon. So the first one that comes to my mind would be, over the last 20 years, the first 10 years of that was a big energy and commodity and emerging market story. It was a very profitable time for energy companies. We had seen coming out of the tech bubble in 2000, we saw a tremendous amount of underinvestment in the simple infrastructure of the energy sector. And that to us suggested there was going to be huge opportunities, and that did play out. Of course, you had emerging markets for the first 10 years of that 20-year period. So when you got to about 2009, 2010, and we actually got to the trough of the bull market in the United States, the beginning of the bull market in the United States, nobody wanted to hear about U.S. stocks. Everybody wanted to hear about emerging markets because they had outperformed so dramatically in the last decade. So the first 10 years of your 20-year period, I would say, were very commodity emerging markets, small cap dominated. That would be the way to think about it. The second 10 years have been a little bit different in that we saw an immense amount of monetary and fiscal stimulus repeatedly, immense amounts of monetary and fiscal stimulus. And because of globalization and the downward pressure on prices, we saw low interest rates. And that gave us a much more speculative, growth-oriented second 10 years of this 20-year period. We saw, even in the fixed income markets, we saw credit spreads become very, very narrow as people began to speculate on lower quality fixed income as well. So I think what's interesting is the first 10 years and the second 10 years of your 20-year period have been very, very different, where the first 10 years was very fundamental, capital goods oriented, valuation oriented, and the second 10 years have been a little more speculative, a little more growthy, a little more interest rate driven.
So what this tells me is that that active management, you are an active manager, you manage portfolios of ETFs in both the equity and the fixed income markets, that active management would be more successful than buying a general index fund, right? And the S&P 500 index fund.
I think that's right. And I think the part of the story, of active versus passive, that there's kind of two things that never get discussed. Number one is, I would argue one of the reasons that active managers have trouble outperforming is that they tend not to take risk, right? And there's great incentive from clients, from investors, not to take risk because everybody chases performance. Mm-hmm. And if you're going to take risk, there are going to be times where you're going to underperform, and that imparts business risk on an asset manager. For obvious reasons. So there's a huge incentive not to take risk. Well, if you think about it, if you're not taking risk and you charge a fee, it's going to be really hard to outperform over the long term. It's pretty straightforward.
And not taking risk, because it's like, what is risk?
You're going to dampen the opportunities that you have out there because, opportunities are usually somewhat contrarian. If you get them right, everybody thinks you're smart. If you get them wrong, people say, like, what were you, an idiot? Why didn't you know that this was a bad investment? There's huge pressure on active managers not to take risks. The second thing that I would point out is that even if you are a passive investor, the notion of being a passive investor is an active decision in and of itself. You have made the decision that you like the largest stocks in an index and that those are the most important within your index. And so, of course, what could happen if you have a smaller capitalization stock rally, your index fund is going to underperform very dramatically relative to the broader market. And I think people forget that. So, we've coined the term at our firm, the cute term, pactive, which is the active use of passive investments, because one of the things that passive investors never talk about is one index to buy and when. And I think that is a critical decision. And I think the current market environment is presenting one of those critical points where investors have to kind of think about, is the next 5, 10, 15 years going to look like the past 5 or 10 years? And do we want to consider an active decision of our passive investment? So passive is a cute term, but I think it's very important in terms of active versus passive investing.
A danger now is that we might think that the last 5 years are indicative of what the next 5 years might be, that we are at some sort of an inflection point, possibly?
I think that's right, Consuelo. I think that we're at one of these points where leadership in the equity market, how many stocks are outperforming, has gotten so narrow, meaning there's very few stocks that are really outperforming, that's distorting the index. So that if you were buying, say, an S&P 500 index or a large cap growth index fund or something like that, the odds are over the next 5 to 10 years, your performance might suffer as that index starts rebalancing back just in a natural format where other companies start outperforming. So I like to think of it sort of as a seesaw, if you will, so that where the fulcrum of the seesaw is the index itself, but we're at such an extreme where the seesaw is so tilted that the index itself may not do very much, and the excitement may be on which side of that seesaw you're on. Clearly, investors are camped out on that one side of that seesaw right now, but by just choosing an index fund, you might miss the opportunity over the next 5 or 10 years on the other side of that seesaw.
So the Magnificent Seven, let's get right to the
Right.
to the heart of this matter of the narrowness of the market. I mean, you had some really shocking facts for me when I talked to you earlier, and that was the market leadership hasn't been this narrow since the Great Depression.
Right. So that's an analysis that comes from Goldman Sachs. I have to footnote appropriately. And they have suggested that this is the narrowest leadership since the Great Depression in the 1930s. Now, there's always an economic reason why you should or should not get narrow leadership. And the work that we did when I was at Merrill Lynch in the early 1990s showed that when profitability rolls over, market leadership naturally gets more narrow. And that's because as profitability starts suffering, markets become a little bit Darwinistic. It becomes survival of the fittest. And fewer companies can grow their earnings, which implies that fewer and fewer companies will outperform as the profits environment gets more adverse. Okay, so in the Great Depression, it makes sense that you would get such narrow leadership because companies were just trying to survive. Forget growing. The story was, could you stay alive as a corporate entity? I think we'd all agree we're not in a depression. We could argue how strong the economy is or is not, but we're not even close to a depression. Corporate profits are actually starting to accelerate in the United States, where earnings growth at the end of this year is going to be up about 15% for the S&P 500 or something along those lines by the end of the year. So, you know, what could be the economic justification for such narrow leadership? We don't think there is economic justification for that. We think this is highly speculative, if not a bubble. I mean, people tend to use the word bubble too frequently. It's certainly highly speculative. And we think that because of that, and again, my seesaw analogy, people are missing or overlooking the opportunities on this other side of the seesaw. The way to think about this, Consuelo, is, are there really only 7 growth stories in the entire global equity market? I mean, of course not. There's tons of them. There's hundreds of them. And it's like nobody cares. It's all about 7 companies. So we think people are overlooking that broader opportunity that's sitting out there.
One of the investment themes, and I'm thinking about back to 2009, when we were in the global financial crisis and also this huge credit bubble, truly a credit bubble at that point. But leading up to that, the market narrative was that the housing prices would never go down. Are we at a similar point where the market narrative now seems to be, it's all AI, just like it was all internet, just like it was all housing. Mm-hmm. Are we in a similar narrative at this point that's overtaken the markets?
I think that's right. One of the things that investors have a very tough time deciphering is the difference between an economic story and an investment story. And so when you're talking about artificial intelligence, AI, if you're talking about AI, first time, if you say anything negative, people go, well, isn't AI going to change the economy? And my answer to that is, of course it will. I mean, who would argue otherwise? What major technology doesn't change the economy? I mean, the internet changed the economy. Electricity changed the economy. The automobile changed the economy. My particular favorite, the light bulb, changed the economy, right? It turned the economy into a 24-hour economy. You can't have a graveyard shift in the dark. It was a huge productivity enhancement. So what you're seeing with AI is not as unusual. Like everyone said, this is an unprecedented period. I don't think that's quite true. I think we've seen this many times in the past. And I think one should also think, realistically, in 100 years, what are they going to think about AI? Is it going to be the way we think of light bulbs? I mean, it probably will be. They'll take it for granted. It won't even be considered technology anymore. So is there an economic story? Of course there's an economic story. That it doesn't mean it's necessarily an investment story, right? The investment story is looking for undercapitalized situations. In other words, investment opportunities that people are overlooking. Right? The way I describe this kind of in English is to say you always want to be the one banker in a town with 1,000 borrowers. Think about that for a second. You're the only banker, 1,000 borrowers, you're going to mint it, right? Because you're going to set the interest rate on every single loan. Turn it around. 1,000 banks, one borrower, the borrower is going to make out like a bandit because the banks are trying to compete for the only loan in town. It's just simple supply and demand of capital that sets your longer term return on investment. So when it comes to AI, it's very hard to argue that they are starved for capital, that we are in a situation where there's only one banker and 1,000 borrowers. Rather, it's more of the 1,000 banks out there flooding the market with capital any way they can. That argues your investment returns will be lower. So the question that I think people should be asking is, okay, everybody knows about AI. It's going to change the economy, great. What are the longer term themes that people are overlooking? Where can I actually be the one banker in a town with 1,000 borrowers?
So you pose the question. So what's the answer? What is being overlooked? Is there something that is bigger than AI, or at least from an investment point of view, will pay off sooner than AI?
My personal opinion is the best long-term investment theme is punching everybody in the face right now. And nobody wants to kind of realize what's happening. And I think it's all about deglobalization. I think we've gone through the last 30 years of ever-expanding globalization. And I think that resulted in two things that are important for investors. Number one, for 30 years, we basically increased competition. And when you increase competition, we all know, you don't need a PhD in economics, we all know that you get downward pressure on prices when you get increased competition. We now call that secular disinflation, which resulted in secularly falling interest rates. And we all benefited from that. I think deglobalization is going to reduce competition, which means that your framework has to change from secular disinflation to secular inflation. Now, what does that mean, right? I'm probably the wrong person to talk about hair on fire events, but I think we have to be very careful in what we say about that. Inflation between NAFTA and tariffs, which I would argue is the period of globalization, inflation averaged 2.2% a year. So between 2 and 2.5% a year, that was great. What are we talking about looking forward? Instead of 2 to 2.5, probably 3 to 3.5. Now that doesn't sound like
Don't
much.
tell that to the Fed.
Exactly. I think this is a big story for the Fed, and does the Fed even realize that? But I think it says that fixed income investing is going to get more challenging. That's number one. Number two is that globalization did exactly what the textbook said it should do, and that is that production went to where it was most efficient. The unfortunate reality is that efficient production was not in the United States. So the U.S. has continued and now runs a massive trade deficit. Now, people have whined about the trade deficit forever, right? But it didn't matter to a hill of beans, because as long as globalization was expanding, we as consumers in the United States just kept getting better and better quality products for cheaper and cheaper prices. Like, who cares, right? I mean, who's going to stand in the way of that? Okay. The problem now is globalization is starting to contract. And the way to think of this theme is, why does everybody understand the national security implications of the United States being dependent on the rest of the world for semiconductors, but they don't understand the risk to being dependent on the rest of the world for everything? For everything. We think this big investment theme is all about the U.S. economy regaining its independence, right? You can call this the reindustrialization of America. You could call it reshoring, nearshoring, friendshoring, infrastructure. It's all synonyms for the exact same thing. But the U.S. is going to have to regain its economic independence. We think that is a fantastic investment theme, that the capital markets will be smart enough to reallocate capital to this very necessary rebuilding of the industrial infrastructure in the United States.
Is it happening already, Rich? And I know that you have, you basically invest with ETFs, and I've also created ETFs at RBA, and so you have an American Industrial Renaissance ETF, 5-star by Morningstar, and which has performed well. And so it's already paying off, but how much more and where is it paying off?
So Consuelo, we started this theme about 10 years ago. Take or leave a little bit on that, but about 10 years ago. Not because we saw exactly what was going to happen in the way things have played out around the world, and our relationship with China getting more tense and things like that. We didn't see that coming. But what we did see was that corporations in the United States were offshoring their production basically for one reason, and that one reason was labor costs. And we thought they were underestimating the logistical problems they could have, the risk to logistics, the risk to supply chains, all these different things. And lo and behold, that actually happened. I mean, I shouldn't be so shocked, but it actually happened. So small and mid-cap, domestically focused industrial companies' stocks have performed exceptionally well over this last decade. You mentioned it's a 5-star fund. That's absolutely right. Now, if you're a 5-star fund, it means you performed past tense quite well, right? It doesn't tell you what's going to happen in the future. People very often ask us, is the story played out? And I would say, look, I don't know what's going to happen in the next 1 month, 2 months, 3 months, 6 months. Who knows, right? But I'm pretty sure that over the next 1, 3, 5, 10 years, this is going to be a very successful theme. But I think investors tend to get caught up in the next 5, 10 minutes. Is this working by the next commercial break? I don't think that's the right way to invest. And in this theme, I don't think it's at all the right way to invest. This is really a decade-long theme.
In the meantime, the Magnificent Seven and the AI theme has paid off handsomely. So what are you advising your clients to do about their holdings in that Magnificent Seven, that narrow leadership sector? What do we do?
So, Consuelo, I'm no smarter than anybody else about these 7 stocks, right? I think their valuations are lofty. I'm not sure that they're unique in their growth characteristics or their balance sheets the way some people are. But that's fine. I mean, I'd love to be able to tell you that the Magnificent Seven will start to underperform, next Tuesday at 1:15 in the afternoon. I'd love to be able to tell everybody that. But that's silly, right? I mean, I'm sure people just laughed when I said that. But the fact that you don't know when it's going to end is the whole reason you diversify. So I don't think I can lend any insight to the Magnificent Seven that people aren't hearing nonstop these days. Here's the way to think about it. We all know that putting our eggs in one basket is not a good idea. Why is putting all our eggs in 7 stocks suddenly a good idea?
In many respects, it seems to be one stock, which is NVIDIA, which is the real superstar. An interesting case to be made, which you have mentioned to me, is that analysts are forecasting by the end of this year that the earnings for U.S. small cap and emerging markets, the earnings growth will be superior to that of the Magnificent Seven. So earnings drive prices.
That's wild. Nobody believes it when I tell them. But if you look at analyst forecasts, you will see by the end of 24, beginning of 25, earnings growth for U.S. small caps and emerging markets will be superior to that of the Magnificent Seven. Now, people say, well, the analysts are going to be wrong. And my answer is, well, wait, why do we trust the forecast of the analysts who follow the Magnificent Seven, and we don't trust small cap or emerging market analysts? So there's something there that earnings growth is broadening quite dramatically, not only in the United States, but around the world. And we think that presents tremendous opportunity because people just don't care.
One investment for a long-term diversified portfolio, and let me serve as a reminder to you, when you appeared first on WealthTrack in 2005, it was a broader mandate for the one investment, and you said
the best way to save for the long term is to save twice as much and take less risk. What everybody's tried to do is save less and take more risk so they can buy the 3rd Hummer or the 4th Hummer. And that's just not a very prudent way to build wealth through time. So number one, I would say save twice as much as you think you really should.
And invest in equity income.
Exactly.
Let those dividends compound.
Exactly. It's a pretty simple way to build wealth, and I've never understood why people don't do it.
So what would your one investment, a specific, as opposed to an action, a specific one investment be today?
So, Consuelo, I would say, getting back to my seesaw analogy before, our portfolios at RBA are very much structured so that we're overweight everything except 7 stocks. I mean, that's really where we don't see the opportunities in 7 stocks. So I would say, if it's a broader, smaller, mid-cap ETF, if it's an emerging market ETF, anything along those lines that's on this other side of the seesaw, I don't think you have to be too sexy about this and be too smart. My personal preference is for small and mid-cap U.S. stocks.
Rich Bernstein, so lovely to have you back on WealthTrack. 20 years later, it's just great to have you on. Thanks so much.
Thanks, Consuelo.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is an unusual one. We are asking you to make a suggestion to us. This week's action point is let us know who you would like to see as a guest on WealthTrack. Who have we missed? Who would you like to see again? We look forward to your suggestions. Email us at suggestions@wealthtrack.com. Next week, Rich Bernstein on the market lessons of the last 20 years. What did we learn? In this week's extra feature, Bernstein shares the activities that keep him mentally and physically fit. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a great weekend and make the week ahead a healthy, profitable, and productive one.